Consumer price inflation for month of October was the lowest in over a year as falling food prices kept the headline numbers well within RBI's target range. What's keeping food prices so low, and does it indicate weak demand conditions? Let's put those questions to Indranil Sengupta, Chief India Economist at Bank of America Merrill Lynch. Indranil, thank you so much for joining us. Firstly, what have you made of this weakness in consumer price inflation and the weakness in food price inflation? What are the factors that are lending to it?
We have always argued that inflation is peaking off because, growth is weak, below potential. So we are effectively seeing that play out as the base effects of last year go away. So that's number one. Food prices are lower than we expected, partly maybe because of a better monsoon. And this is something that we'll keep a watch, but food prices are certainly lower than we expect.
Indranil, good afternoon. Ira joining in. Just to stretch that conversation a bit further. So, if it was weakness in demand conditions, should it not be showing overall on the index? This time around, core inflation was higher. It does seem like there's something playing out, particularly in the food economy and maybe in the rural economy, because rural inflation this time fell quite sharply compared to last month's numbers.
Well, if you look at core inflation, a lot of it is driven by base effects. It's the same base effects which took the headline up and is bringing it down. You will see that play out similarly for core inflation. In the next coming months, you will see core inflation coming down. So that's point one. Number two, to some extent, maybe, as we've had a fairly sharp depreciation, that could have some ripple effects on core inflation. We have to watch that for the coming few months. So I think that, it's basically those two factors at play rather than any sharp differences between the rural economy and the urban economy at this point in time.
Indranil, so how do you think the RBI is looking at this? Will it force the RBI to shift to a neutral stance? And if inflation continues to undershoot its target, then what happens to their calibrated tightening approach?
Well, we had a cut call, in fact, for August, if anyone remembers. But clearly with inflation where it is, the RBI at least has to be on long hold. Because the real rate, ex post is obviously very high now. And the next month, inflation is going to fall below 3%.
That is true, Indranil. I think, if I'm not wrong, in the last time's MPC, I think Ravindra Dholakia spoke about the real rate. It is becoming quite relevant right now, particularly since, we were talking about the pickup of the investment cycle, but with real rates, I think in excess of 2.5%, if you go by the latest round of numbers, that would impinge on investment as well?
No, we think that, interest rates clearly need to come down for recovery. That has been our stance all the time. So we do think that at the least, I think if the RBI now starts to step up open market operations and pushes down bond yields, that will also help to bring down, lending rates.
What about industrial production as well? We've seen that industrial production has further weakened in September. Capital goods production in particular has seen a sharp fall. What have you made of these numbers?
No, again, just as there was a base effect in inflation numbers. There's also a base effect in growth numbers and in credit numbers. So as we go from here till March, you will see growth numbers weaken on a year-on-year basis because obviously the base is going to turn around. So just as inflation went up and has come down, you will see growth also, coming down. You will see loan growth also, maybe softening to some extent from current level.
All right, Indranil, just last word then, how this stacks up also in terms of what it means for rates in the market. Liquidity has sort of remained tight. Are you comfortable with the extent of liquidity support from the RBI, or do you think more would need to be done? Because then that could really bring down rates. If inflation is in check, rate expectations on the repo rate side change, and there's enough liquidity, then you could move back towards perhaps 7.5 on the 10-year.
Yeah, so we are expecting the RBI to step up OMO to 50,000 crore a month between December to March. As you can see, the money market is short by almost 80,000 crore, and, we will be entering the busy season. So we think that the RBI needs to put in about 2 lakh crore more of OMO between December to March. And that should help to bring down yields, even if, the RBI continues with its present monetary stance, which it just changed.
All right, Indranil, we'll leave it there. Thank you so much for joining us with your views. That's Indranil Sengupta from Bank of America Merrill Lynch.